Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video we are going to be talking about lesser known but highly effective moving average, the volume weighted moving average known as the VWMA. You will learn what sets the VWMA apart from other indicators. You would also know a step-by-step strategy to use it in your trading. So stay tuned to discover how this overlooked tool can enhance your technical analysis and your trading approach. We start by understanding what the volume weighted moving average is. And the VWMA is a type of moving average that incorporates both price and trading volume into its calculation. Unlike the simple moving average, which gives equal weight to all price points, the volume weighted moving average assigns greater importance to periods with high trading activity. This makes it more reflective of where more trades have occurred, providing a clearer view of market sentiment. The formula for the VWMA is straightforward, multiplying each closing price by its corresponding volume, summing these values and then dividing by the total volume over the specific period in time. Now let's see how we can apply the volume weighted moving average to our trading strategy effectively. One of the ways we can trade using the volume weighted moving average is by employing it as a trend following tool. This strategy focuses on identifying pullbacks within a trend and using the VWMA as a dynamic level to time entries. The idea is straightforward, and an uptrend is very straightforward. In an uptrend, the VWMA acts as a support, while in a downtrend, it acts as a resistance. This is how you can use it. By aligning your trades with the prevailing trend, you can improve your decision making. So we start by understanding or identifying the overall market trend. By the rising of the VWMA, it indicates an uptrend. When you see a rising in the VWMA, this is the indicator here. Let me tick in the line so that we wouldn't confuse ourselves. Very good. When we see a rise in the indicator, it indicates an uptrend. Then when we see a fall in the VWMA indicator, it indicates a downtrend. Confirm this by observing whether the price is consistently staying above the VMA or staying below the VWMA. For example, in an uptrend, price will generally remain above the VWMA, while in a downtrend, it will remain below. Now, once you have identified the trend, you wait for a pullback towards the VWMA. This retracement represents a temporary pause in the trend. When price is consistently above, you wait for a pause in the trend by price pulling back to the VWMA. Then when price gets to that area, you look for a bullish engulfing pattern near the VWMA that can signal buyers are ready to step into the market to push price higher. So at this area, when we see an engulfing candle, even at this area we see an engulfing candle, this would have been a perfect position for you to enter your buy trade. This is where you want to enter the trade. Then in terms of a downtrend, the bearish pattern like a shooting star near the VWMA can indicate a renewed selling pressure. You step back and look at price trading below the VWMA, and when price comes back to retest the VWMA, you look for your pattern like a shooting star or an engulfing candle, and this is where you probably want to enter your sell position. Once you have entered the trade using the VWMA as your dynamic guide for managing your risks, you would set your stop loss level. In an uptrend, you put your stop loss just below the recent swing low. And as you can see, this was the swing low here. You put your stop loss just below the recent swing low. Then in a sell trade, you put your stop loss just above the recent swing high. You put your stop loss above the recent swing high. This is where you put your stop loss. The strategy works best in a trending market where momentum aligns with the volume. This is where the trade strategy works best well. It is less effective in a range-bound condition or during period of low trading activity. So always ensure that you're trading with a clear trend before identifying your approach. Your take profit, you can use a fixed take profit of 1:2 or 1:3 as the case may be. A minimum of 1:2 can be a perfect way to exit your trade. Standard of 1:2. Let's look for another example to better explain the strategy. Now we can see in this area when price was constantly above the VWMA indicator, we can see that price came back to retest the VWMA indicator, and we can see a hammer candlestick pattern and price closed above the hammer. This signals our buying trade. We would enter the position at that area. We put our stop loss just below the swing low. Then we aim for our fixed takes profit of our fixed risk to reward of 1:3 or 1:2 as the case may be. Now for a selling opportunity, price is constantly below our VWMA indicator. The moment price came back to retest our VWMA, this would be a trigger when price forms our bearish engulfing pattern. This is a candlestick pattern that signals our bearish reversal. This is, you enter the trade after the bearish engulfing candle, and you put your stop loss just above the last previous swing high, and you aim for your risk to reward, a fixed risk to reward of 1:2 or 1:3 as the case may be. This is how you can apply this approach to your trading strategy. Apply the volume weighted moving average to your trading strategy. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, subscribe, and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.